We postponed this webinar from March 27 as I was sick, but we're ready to dive into stablecoins. The space, of course, has taken a quick change in the past couple of months. So we'll start off by doing like a overview state of stablecoins in 2024. Where are we? What has changed over the past few months? And then we classified like the main types of stablecoins within DeFi that are getting traction. We start with strategy-backed stablecoins, where I imagine many of you have heard of Athena by now. We'll cover a lot of indicators there. Then transition to collateralized debt positions, namely MakerDAO with DAI, Avigo, and Curve CRV USD. Finally, real-world asset-backed stablecoins, which were catching some momentum, has seemed to waned off a bit over the past few months, and end up with an outlook, some opportunities and considerations for the space throughout the rest of the year. Before that, quick update of Into the Block. We've been shipping nonstop a lot of products. Recently, right on time for the Ethereum Foundation lawsuit from the SEC, we launched a dashboard looking at the flows of how much ETH is held by the Ethereum Foundation. If they're selling, they're buying. You can track their holdings near real time. You can check that they basically timed a lot of the tops with the net outflows, essentially selling into exchanges. Though in terms of ETH, they've been held less and less over time. Very timely. We're about to launch this, I believe today or tomorrow. Bitcoin halving dashboard. We're just 15 days away from the halving, so you can track like the not just price performance, of course, but also the effects on issuance, holding concentration, a lot more. So keep an eye on that one. We'll be launching it very soon. And on the risk product side, we launched Prisma, which is a collateralized debt position stablecoin. We'll be talking about it throughout the presentation. And also very timely, we're about to launch Athena USD, which we've been in collaborations with for the past few months. And we're very excited to launch USD metrics, analyzing the risks in DeFi for Athena, which I'll touch on more. So where are we with stablecoins at the moment? So stablecoins have faced in 2022 and until 2023 a bit of a slump as markets in general have, of course, cooled down in 2022 and towards the late end of 2023. It has been resurfacing. You can see here the total market cap of stablecoins has been a bit of a lagging indicator. So it didn't re-accelerate until Q4 of last year, when the market really bottomed more like in Q4 2023, continued declining regardless. And it also peaked later into May 2022 instead of November 2021 when the overall market cap peaked. So we do see this as a bit of a lagging indicator, and it's essentially the flow of liquidity entering and exiting the system of crypto, with real rates being quite high as the Fed increased rates. A lot of the stablecoin demand was essentially withdrawn from the system and going into traditional system. And we see now as the risk-on sentiment is back into crypto, it has been re-accelerating very significantly since Q4 and in Q1 at an even higher rate. So I think we're, as I'll touch into later, we're probably on track to reaching new highs towards the end of the year. Then we see another of the key changes is that USDT dominance is at its highest since early 2021. USDC took a lot of market cap in 2021 and 2022 as it really embraced DeFi early on. And still to this day in many DeFi protocols, there's more USDC liquidity than USDT. But in centralized exchanges, USDT completely ate the market. And then, of course, after the SVB, Silicon Valley Bank collapse, we see that USDC dominance has really decayed. So it peaked around early 2022, and then late 2022, sorry. And then in March 2023, USDC market share went off a cliff as it depegged essentially, and people began redeeming a lot of USDC and swapping it for USDT in some cases. And we see USDT now reach over 100 billion, by far the largest player. Though there are some smaller players within DeFi, which we'll get into, that have been increasingly growing. And in terms of volume, we see demand picking up for stablecoins. So we are currently in March, we experienced the largest largest volume for stablecoins in general on chain. Largest, I believe, about 700 billion in transactions of stablecoins just within the Ethereum network. So crazy amounts of volume, largest since 2022 when FTX collapsed. And it seems like we're back on an upward trend. And now we'll focus particularly for the rest of the webinar in DeFi stablecoins. What I mean by that is essentially those that you can access openly within crypto. Some of them are more centralized than others, which is a caveat that we can discuss in further depth. But in terms of growth, the sector has been very much in a K-shaped recovery, I would say. Some stablecoins have seen massive growth and others have slumped down a bit. So here are the top 5 stablecoins in DeFi at the moment in terms of market cap. There is DAI, just the regular DAI that is pegged to $1. Its market cap of $5 billion. It's backed by essentially collateral that's issuing debt and partially by real world assets, so a smaller amount of it at the moment. It's not yield bearing, and the market cap has decayed slightly by about 5 to 6% in the last quarter and year. Then there is SDAI, which is the savings DAI, the yield generating version of DAI. And this one has really kicked off like a new trend for stablecoins. It's currently offering 13% APY based on the earnings that they make from borrowing DAI and partially also their real world holdings. And it's grown by over 1,200% in the last year, though less so over the last quarter. Then we have the new entrant, Athena, probably the most a buzz project at the moment with USDE, with a market cap of 1.5 billion. I think it's as of today closer to 2 billion. This was as of Monday, which essentially is backed by market neutral strategies, which I'll explore in a bit more depth. USD itself is not yield bearing, though they do have points programs that are essentially indirect yield projected as much as 190%. And it's grown by 1,500% over the last quarter. And essentially, I'm putting infinite here because it hadn't launched a year ago. It launched on a closed beta, I believe in November of last year. The open mainnet launch was in January, so insane growth in just a couple of months. And then Frax has seen a bit more of a decline. It's backed by real world assets and USDC, which of course is also backed by that. It's gone sideways over the last quarter, over last year. However, it's lost more than a third of its market cap. And then there's SUSD, which is a yield generating version of USD, very similar to SDAI, which has also very much outperformed. Now I want to get into some nuance of the different categories of stablecoins, just to make sure we're all on the same page. I would say there's about 3 or 4 types of stablecoins. First ones are like the centralized assets, centralized backed by assets. So USDT, of course, backed by treasuries. None of that gives the yield to the user. And then there's the opposite, which is USDM, which does give out the yield to the user. But it is at the end of the day backed by the same. There's also Ondo Finance and a couple more projects doing this centralized approach to essentially stablecoins being backed by real world assets. Then there is the collateral backed debt positions. MakerDAO, of course, being the pioneer behind this. Liquidity LUSD is another project. Aave, Curve CRVUSD, Prisma MKUSD. There's several players now. I'll touch into them in a bit more depth soon. Then there is the strategy backed, is what I'm calling stablecoins. Athena USD being the main player, but it's really piggybacking on the work that UXD and Lemma, some of the earlier projects, kicked off in the last cycle, but scaling it to higher size. And then we have unbacked stablecoins, which have largely fallen out of favor post Terra. So let's dive into the man of the hour, essentially. Market neutral strategies are the backbone for stablecoins like Athena or UXD. Essentially, they work by having neutral exposure to one asset, doing so by going long stake ETH and shorting Ethereum perps and earning yield on both sides. So this is a trade that essentially anyone can do in their own accounts. But what Athena does is that it simplifies it and it scales it across multiple venues and multiple staking assets, so that the user just does it in one click, and gets exposure to this synthetic dollar, which is, they call it this way because it's a little less stable than your average stable coin, but it does provide a lot of yield. So SUSDE, the yield earning version of it, has been earning between, on the low side, 10%, on the high side as much as 60%. And so the growth has honestly been one of the largest drivers, I guess, that we've seen within crypto over the past few months. Nearly 2 billion in market cap for USDE, and over 10 billion in fully diluted value for Athena governance token, which just launched in just 3 months. Of course, 3 months since launch, they've been working on this for over a year and a half, I believe. And the main driver is essentially the yield. The APYs, as I mentioned, have been between 15% to 60% on SUSD, mainly because of the funding rate yield has been quite high. And then they also have, to further add fuel to the fire, they have their own points program, which initially they called shards, now they're calling sats, where they have a boost of 150 to 300% APY by locking in your USDE and different DeFi protocols. Of course, and this is very paramount, none of this is financial advice, but there are many risks to consider when looking at something like Athena or any stablecoin, really. There are 4 main risks with USDE. The first one that is most apparent to everyone is that there are risks when funding rates go negative. Essentially, you could potentially be losing, and that is theoretically correct, though it's not really as feasible or as practical as one might think at first glance. This is a chart of the interest funding rates over time in perpetual futures. They have been consistently positive, I believe just negative in about 10% of the time. And of course, during bull markets, that is an even smaller amount of time. With the past few months, we've seen as much as 100% annualized funding in many protocols, in many exchanges. And also this risk is self-correcting. What I mean by this is essentially Athena holds a lot of short positions in funding rate perps. And if the rates go negative and essentially begin losing, they close off positions, which leads to the correction of those yields, in which they close the short positions and leads the funding rates to become more positive as the market rebalances. So it's not as bad. It's not, that risk is not itself as nearly as bad as something that was self-reinforcing, like in the case of USD. So that one is somewhat manageable by a team. There's liquidation risk, which is essentially you are trusting, and like this is the case at the moment very much, you are trusting the Athena team to execute properly on your behalf. If the market rises and they don't rebalance positions, those short positions get the risk of being liquidated. They have a team of traders at the moment essentially executing this. So you have the risk that their execution has some issues, and therefore there's some centralization risks there as well. Then that you have custodial risk. So a lot of the positions are held in centralized exchanges, but the caveat here essentially is that they're managing to do so in a less custodial way through what's called off-exchange settlement, which they pioneered, oh yes. where the assets are not held directly in the exchange, but through a custodian like Copper, which executes the trades on their behalf. And it's sort of a way of mitigating the collapse of one of the exchanges. So if you have active positions, it's less manageable. But it's a good in between centralized exchanges and like decentralized exchanges where the custody is not fully at the disposal of the exchange, and therefore something like FTX running away and taking your money seems less likely for this. And finally, you have collateral risk, which you get exposure to liquid staking tokens, a whole basket of them, and potentially, they could get exploited and lead to the stablecoin not being fully backed. All of those risks essentially materialize if they were to happen on the peg of USD, since it's supposed to be fully backed. So far, it's only had minor depegs, as we can see here. This is from our risk dashboard we're about to launch. Less than 1%, it's been depegged. And it's even traded at premium, since the market essentially buying USD to get access to the points program. Especially with the success of the ENA governance token launch, which, as I mentioned, is trading at over 18 billion fully diluted at the moment, I believe. Now let's talk about into the second main category driving stablecoins this year. It's collateralized debt positions. Growth in the market here has lagged a bit behind USDT and, of course, Athena, though it has re-accelerated as well. And the main changes we've seen is the launch of new entrants, namely Curve CRV-USD, Aave Go, also Prisma MKUSD, and a few others over the risk spectrum, which are backed by LRTs. MakerDAO, even though the DAI supply, as we see here, has been not really appreciating that much, they've made a lot of changes to the protocol to be able to monetize more their debt. And therefore, we see here the revenues have been increasing at all-time highs, essentially, as they get higher share of the profits, and not just from the treasury holdings, but of course from borrow rates increasing, which they did here, and the large amount of leverage in the system, they're monetizing it at a lot higher rates than they used to even in 2021. Then we have Curve CRV-USD, which pioneered this lending liquidating AMM algorithm, short for Llama. And in it, they introduced soft liquidations, which essentially have an AMM, so taking advantage of the Curve infrastructure. Your lending position, the collateral is in a AMM, and if your position drops below the liquidation point, you're essentially partially liquidated. So say you get a loan with Grab Bitcoin, part of your collateral is liquidated and goes into an AMM pool, but it could potentially, if the market recovers, you can recover the whole value of your position without any of it being liquidated. So it's complex, but it's a lot more friendly for borrowers in that sense. And it also has the added benefit of the Curve liquidity, where they've been able to bootstrap CRV-USD through incentives and the whole flywheel of Curve. At the moment, it's mainly backed by Grab Bitcoin, but they do have several collaterals available. Then we have Aave Go. The core proposition here is to offer lower borrow rates than in their lending protocol by minting Go. So at the moment, I believe it's around 8% mint Go, was a lot lower when they initially minted it. And the idea is for these rates to always be slightly lower than market rates to make this more attractive. Initially, however, they launched it without any redemptions, which led to it not being able to hold its peg at first. This is from our Go risk radar. It went as low as a 5% discount, even though it was fully backed at all times. But since the launch of the Go Stability module around here in late January, the peg has repegged across most stablecoin pairs. And they've also introduced staking, where you can put Go in the staking module and earn some Aave tokens in order to essentially incentivize people not selling what they borrow in Go. Finally, we have real-world asset stablecoins. These were really a buzz in early 2023, as you know, Fed interest rates were increased to over 5% for the first time in, I believe, 10 years or more. And therefore, it created the opportunity for people to earn that yield easily through stablecoins. SDAI, which we can track here through Maker RWA, gets that exposure. And it was one of the first ones offering this. But then also we've seen newer entrants like Ondo and Mountain Protocol, which really rise in 2023 and have sort of slumped over the past few months. Essentially, the core composition is just giving the yield to consumers, whereas something like Tether doesn't, like, keeps all the yield as profit. Here, the yield is passed on to the users. And in a way, in 2023 in particular, it created a floor for DeFi yields, since it was able to create that arbitrage opportunity where if treasuries were at 5%, but borrow rates were at 3%, people would just borrow up to that level of 5%. And that allowed the markets to recover and rates to start increasing again over time. That being said, as I mentioned, they have struggled a little over the past few months and are likely to struggle even more if the Fed decreases rates as they're projected to. So in reality, it's more of a bear market product, in my humble opinion. Though, of course, there's a lot of opportunities for real world assets. So we saw over the past few months, I guess, week, BlackRock launched their Biddle real world asset fund. It's not a stablecoin per se, but you can see how things are trending. We're likely to start seeing more tokenized ETFs, stocks, real estate, and even compute. And those could be the backing of very interesting stablecoins, of course, each of them with different risk profiles. Now let's dive into the outlook for stablecoins. We are seeing continued acceleration of stablecoins within centralized exchanges and across the developing world. We're seeing adoption of USDT principally, as it acts as a store of value for people that who have much more volatile fiat currencies. So they are seeing some real world adoption. Decentralized stablecoins are also seeing adoption, but they're doing so within a much smaller group of people. These are particularly from people that want access to yield and opportunities within DeFi ecosystem. Within this, we see the drivers of high yields strategy stablecoins like USDE. These are likely to accelerate. So as more people essentially go long in the bull market, there will be larger funding rates, and this can be arbed out by more USD being emitted and getting that yield, which also, of course, decreases the funding rate slightly and increases the demand for more leverage. So that's in a reinforcing loop that I think is likely to continue accelerating over the rest of the bull market. Not sure if that'll be the next 6 months or the next 2 years, but it's very apparent that as long as there's bullish outcome, those strategy-backed stablecoins will grow. And I think it will span not just with Athena, but we're also seeing some newer projects that are looking at doing other types of strategies that are market neutral and monetizing them through a stablecoin. So I think we essentially unlocked that, and it's likely to be a key driver for stablecoins within the next cycle. Though it won't be just a straight line up. We're likely to experience deep diving events, not just in Athena, but in many of these stablecoins, as they have many components and they're all building essentially on top of Lego blocks. As I mentioned, Athena has a lot of liquid staking tokens, and they also have positions that are going short perps. Now Maker is looking at having part of DAI being backed by Athena. So we're stacking and stacking on risk, which could be positive from the yield standpoint and revenues, but also adds a lot of risks into the system. So happy to dive into those potential conflicts rising. But essentially, yeah, we're seeing some protocols embrace these newcomers like Athena, where others like Aave have been more hesitant to adopt it, and there's some infighting within DeFi at the moment. To conclude, demand for stablecoins has been accelerating in 2024, since 2023 really, but at a higher pace in 2024. The landscape is changing, and Athena has been one of the main projects, creating these changes due to their high yield that they offer. Also, since their positions are in CeFi, we're seeing the worlds of centralized exchanges and DeFi be more intertwined than ever, where now it's easy to arbitrage yields between one and the other. Real world assets were very much of a buzz term in early 2023, but are seeing slower demand over the past few months. I think this is likely to continue over the foreseeable future. And riskier stablecoins are likely to continue growing as the bull market environment really adds fuel to the fire. That's it for today. Thanks everyone for hopping on. Make sure to sign up for the next webinar. We'll be talking about yield AMMs. So Pendle is a main player here. What are the mechanisms behind them, and why have they grown so fast? Pendle has also been working a lot with Athena, so there's a lot of connections there if you're interested. They have crazy yields on the points of 150% plus. So we'll be exploring those opportunities. Of course, also not financial advice, but it will be very interesting. Super complex protocol, so we'll be diving into that in the next one. And with that out of the way, I'll be sticking around for questions for a few minutes.